Well, if your portfolio is up nicely this third quarter, our market monitor has some ideas on how to keep it going into the fourth. Joining us tonight, Shawn O'Hara is president of Pacer ETFs. This is his first time on Nightly Business Report. Shawn, good to see you. Welcome. Thanks for joining us tonight.
Thank you for having me.
You're looking for value going into the fourth quarter, and I'm going to start with your first pick tonight. It's Micron Technology. The chip stocks have suffered, and Micron this week had a pretty tough week as well. Why do you like it here?
Well, we like Micron Technology because we like the harder side of tech as opposed to the softer side or the social side. We're overweight technology in several of our funds. And Micron, as a chip maker, we have this concept we call the four horsemen of the internet: artificial intelligence, autonomous vehicles, e-commerce, and streaming. And the demand for these chips will be increasing as those types of services increase as well. And they generate a lot of free cash flow. And it trades at a very, very low multiple.
You're not worried about pricing pressures. That seems to be the problem for a lot of the tech companies right now, the chip companies.
Yeah, I mean, there's a lot of competition. We own several of the chip makers, but the demand, I believe, over time should outstrip the pricing pressures because the demand, we believe, long-term is fairly significant.
Right.
Okay, number two is Equinix, which is kind of a bet on the cloud.
Yeah, Equinix is a publicly traded real estate company. When most people see companies like Amazon or Google or Microsoft talk about their cloud business, it's not really a cloud. It's actually a data center that they're generating revenue out of. Equinix is the largest data center operator in the United States. 70% of all internet traffic in the U.S. flows through one of their centers. And as these big behemoths compete and try to grow their cloud business, and this also feeds into the previous theme of the four horsemen, we believe the demand story here is very big as well.
Finally, a high-profile retailer, Nordstrom, they've had a tough year. They were for sale, then they weren't for sale. They're competing with companies that are going online. I mean, it's been a tough time for this company. Why do you like them now?
We own a specialty basket of retailers, which Nordstrom's in. We screened in because of their free cash flow. They generate a lot of free cash flow. I think as far as position versus other retailers, they had fewer stores, so they didn't have to take offline those stores and deal with that problem. They've crafted, we think, a pretty nice strategy here, a multi-channel strategy, which is in-store and online. And then Nordstrom's and Nordstrom's Rack, which is a discount operation, and they've cobbled together a nice loyalty program for those. And again, they generate a lot of free cash flow, and the management now is committed to buying back stock. So we look for Nordstrom to continue to perform like our other retail players.
All right, very good. Shawn, again, thanks for joining us tonight. Appreciate it.
Thank you.
Shawn O'Hara with Pacer ETFs, and you can read more about his picks on our website at nbr.com.